Hello, and thank you for joining today's Tech Summit Series webinar. My name is Jess Offer, a partner in Withum's Technology and Emerging Growth Services practice. Today's webinar will consist of 3 sessions. The first will feature a presentation that will examine the economic trends and outlooks for interest rates, inflation, labor markets, business conditions, and the state of the consumer. The next 2 sessions will cover the trends with business valuations and tax energy credits and their impact on tech companies. If you have any questions during the presentation, please submit them through the Q&A tool. We will do our best to address them at the end of each panel. With that, I'd like to introduce our first keynote speaker for the first session, Ginger Chambliss. Ginger is head of research for commercial banking at JP Morgan. In this role, she produces curated thought leadership content for CB clients and internal teams. Her content focuses on economic and market insights, industry trends, and the capital markets. Thank you for joining us, Ginger.
Thanks so much, Jess, and thanks everyone for having me, and thanks for joining today. No shortage of topics to cover regarding the U.S. economy. It's been an eventful year, and today will be an eventful day because the Federal Reserve or the Federal Open Market Committee will be deciding on what to do with monetary policy, and we're expecting the easing cycle to begin, meaning that interest rates will be coming down after being at pretty high levels for a prolonged period. So let's jump right in. I'm going to share my screen, and I have a presentation just to walk through and kind of guide the conversation. There are mixed trends across the economy right now. There are definitely some aspects that still look really strong and have been really the drivers of a resilient economy in the U.S. And really more than expected. I think coming into the year, recession expectations were kind of 50-50. As the economy has performed well, driven in large part by a resilient U.S. consumer and consumer spending. It drives 2/3 of annual GDP growth in the U.S. So it's been kind of an important element of overall economic activity. And the consumer has kind of continued to contribute to the economy with spending growth. Still elevated levels of government spending or fiscal spending. A lot of this relates to legislation that was passed a couple years ago to kind of make investments in certain critical industries and also our infrastructure. So spending levels kind of at the government level have been elevated, and that's also contributed, I think, to some of the economic upside that we've seen. You know, on the flip side of that, geopolitical tensions are high, and so outside the U.S., there are things to think about and risks to consider vis-a-vis potential for volatility in commodity prices, foreign exchange rates, also supply chain disruptions. So those are some of the risks that are out there. Also, just with interest rates having been at elevated levels for a prolonged period, this can start to take a toll. And we've already seen this in certain areas of the economy that are most sensitive to higher interest rates. The U.S. housing market has been much softer in recent years in terms of activity levels, a little bit less so in terms of home values, which remain very elevated. But also commercial real estate is an area that has been under pressure in the higher interest rate environment. And then also manufacturing. Think about our economy kind of in manufacturing and services kind of being two key segments. Manufacturing has been a little bit more subdued, and services have been a little bit more robust or resilient. Um, in terms of the outlook around interest rates, uh, like I said at the top, today's an exciting day. We do expect the Fed to move. It's really kind of unique that there isn't uh, um, a more clear consensus on what the Fed's going to do. Usually, this is pretty well telegraphed ahead of time. But whether the Fed moves 25 or 50 basis points is not totally clear. They're usually a little bit more proactive in kind of getting the message out. But I think it really speaks to the fact that the data is still mixed. The Fed manages to a dual mandate of stable prices, which they kind of qualify as 2% inflation over the long term, and full employment. And both of these are, I mean, they have the inflation target. What full employment, there are probably a couple of different ways of looking at this, and it's in many ways kind of an estimate. But it with our demographics and our economy, that probably means an unemployment rate in the low 4% area, which is kind of right where it is now. So, but we know rates are restrictive or sort of providing kind of a little bit of restraint on certain areas of the economy. And the Fed recognizes this. Also, even though unemployment rates of low 4% right now looks about in line with where we want to be, they've come from even tighter or lower levels. About a year, 18 months ago, hit the low 3% range. So it has been moving upward. And I think what the Fed wants to avoid is having it continue to move up and have sort of an unnecessary weakness in our labor markets that could tip the economy into recession. So they're balancing that. It's not a clear call, but really the more important takeaway is that the easing cycle is beginning and the outlook for interest rates is lower over the next 18 months. And we expect that the Fed will move at a pretty brisk pace to bring that Fed funds back to kind of a 3% area by the middle to later part of next summer. In the meantime, there has been a bit more volatility in treasury yields, and so interest rates that kind of float and are a bit more market-based, as those markets have tried to price in how many cuts the Fed will be doing. But at this point, interest rates are modestly lower than where they started the year. Clearly, the chart on the right, you see a fair amount of volatility up and down, as you know, markets have kind of been digesting various macro data points. But nonetheless, our outlook now is for rates to be kind of at these levels or lower over the next year. And I think that's generally good news if you're a business leader. Lowers your cost of capital, potentially opens up opportunities for strategic activity. And so all of these things I think could be sort of a positive in the year ahead. I noted earlier how GDP has been resilient and really growing even above kind of longer term trend growth, which is 1.8% for the US economy, would be kind of like what we would expect in a quote unquote normal year. And it's been surprising to the upside. The second half of 2023 was particularly strong. When we turned the corner into this year, we thought we'd see a lot quicker moderation, but again, it's continued to surprise to the upside, and our outlook now for the full year of 2024 is GDP growth of about 2.5%, which is slightly above the longer term um, expectations. In terms of recession expectations, those have also similarly come down. So it's kind of consensus and kind of markets, forecasters, a broad range of participants are not expecting recession in the near term. I've talked a fair amount already about the consumer and how consumer spending has been, very important engine of the U.S. economy and has been one of the key drivers of the upside this year. Here we're just kind of taking a snapshot of a few aspects of kind of state of consumer finances or household finances. And in large part, they still look pretty solid. Uh, Debt levels and kind of debt servicing levels still appear manageable in a longer term context. That's kind of the chart on the lower right. On the left hand side is kind of the composition of household, again, at an aggregate level, assets and liabilities. And I think something that's been very unique this cycle of the higher interest rate environment is that consumers have been pretty insulated from those moves higher in interest rates. And that's because so much of consumer debt is mortgage debt. And the outstanding mortgage debt is currently a high percentage of it, 75% of it is locked in at low fixed rates of below 4%. So that's really insulated the consumer from these moves higher in interest rates. And then again, and there's a lot to talk about around the housing environment in the US, but one thing that for homeowners, home values make up almost 30% of overall household assets, and home values are near all-time highs and up, I think it's over 50% or so from 2019 levels. So that's, again, kind of providing a cushion and a tailwind support for household and consumer spending in the US. Now, it's not a rising tide lifts all boats environment. And I think, like, when I have these conversations across our client base, you can really get a good feel for, what the end market is or what the, sort of category is that different business leaders are, what their customer base is, because we've gone from kind of, very resilient spending kind of across all categories to much more noticeable differences between goods and services. On the left-hand side is a longer-term perspective in terms of how consumers are spending their dollars. And over time, consumers in the US have been spending more on services relative to goods. You can see the time period right around the pandemic, that really long kind of secular trend was knocked off course. And we're in the process of kind of returning back to that pre-pandemic mix level. And so what we're seeing is consumers still spending relatively more on some of those going out categories or service-oriented categories. Travel's been a big one. Live entertainment, dining out, all these types of categories have been outperforming in this environment, while a number of goods and durable goods categories have been a little bit more muted. And so there's still that kind of normalization pattern unfolding with regards to consumer spending. In terms of inflation, inflation spiked to 4-decade highs in kind of the 2021-2022 period. There were a number of factors that contributed to that. Clearly, the pandemic and the supply chain bottlenecks, combined with a significant amount of fiscal stimulus or government payments, transfer payments to consumers during that time period. So you ended up with kind of excess liquidity and pent-up demand on the consumer side, spending side, and then you had sort of constrained supply. And the combination of those factors, and then add on top of it the commodity price volatility that took hold in the early part of the Russia-Ukraine conflict, all of those factors combined caused inflation to spike higher. Okay, that it's kind of had to work its way through the system, and we've seen that start to ebb. But as you can see, and this chart here on the left-hand side is looking at core inflation trends. We've made a lot of progress back towards the 2% level, but it's not quite there. I think that's, again, if we come back to what the Fed's going to do this afternoon with interest rates, is to the extent there's part of the committee that is sort of looking more at this inflation and wanting, it to get even closer to target before easing rates materially. That could be part of the discussion there. Earlier in the year, and I think this is also what's made kind of this monetary policy discussion a bit more challenging, is the data. It's not totally clear cut. And even earlier this year, there was kind of like a stall in the progress on inflation. So last year we had about 200 basis points of inflation moderation. So far this year, it's been only like 30 to 40 basis points. So the pace of improvement has slowed, and I think has kind of, called into question, how embedded inflation is. Can the Fed get it that last mile of inflation down? So that's the story on inflation. In terms of labor markets, we have seen an uptick in the unemployment rate, but a lot of that is being driven by increase to labor supply or sort of labor force. And it's much less driven by layoffs. We've continued to add payrolls across the US month in, month out through 2024. The number of payrolls that are being added is gradually, slowing. And there are fewer sectors or industries that are still adding payrolls at significant levels at this point in the cycle. But it's been very small levels of layoffs thus far, but there's also reduced hiring activity. So that's sort of, I think, what's causing this increase in the unemployment rate, combined with some increased flows of immigration. And I think I have that maybe on the next slide. But one of the charts that I think just really speaks to dynamics in the labor markets is one I have on the upper right-hand side here. This is looking at open jobs relative to job seekers. And so it really kind of gets at how tight our labor markets. Coming out of the pandemic, we had far more open jobs than we had job seekers. And so that caused tightness in the labor markets. It made it hard to hire, retain workers, and put some upward pressure on wage growth. Employers were having to increase their wage levels um, to get workers to fill those open roles. And so that is the dynamic that we're kind of got showing on the lower chart here, is in terms of that darker blue line is looking at average wage growth. It's been a bit elevated relative to pre-pandemic levels, but something that's important to note there is that the kind of jump in wage growth that we saw 18 to 24 months ago was not the cause for the inflationary dynamics we were experiencing. Wage growth has lagged the pace of inflation until about 12 months ago. And so it's been modestly running ahead of inflation the past year, but I would expect both of those trends to moderate into 2025. I'm going to flip forward to the next slide here. Talk a little bit about demographic trends in the US. So I noted how immigration flows have picked up in the last couple of years. This is the statistics around this are on the lower left-hand chart here. And then the lower right-hand side is really sort of like the trend in foreign-born workers as a percent of our workforce. So it just shows how immigration contributes to our labor force. And when those flows, kind of change trend, accelerate, which is really what we've seen over the past couple of years, it can, have influences in things like the unemployment rate and stuff like that. So that's one of the reasons that we're seeing a little bit of a higher kind of labor supply in the US relative to the demand side. And so it looks like labor markets are coming into better balance. I think that's the big takeaway on labor market dynamics. This top chart, I think, again, this is a very just sort of like big picture dynamic to be aware of in the US looking forward, is that we have an aging demographic. We know that. And the birth rate has been muted and is likely to remain so over the coming years. But looking forward the next 15 years or so, by the early 2040s, we will have more deaths than births in the US. And all of our population growth from that point forward will be driven by immigration. So again, it's something I think it's, particularly when I speak to the tech sector and innovation economy, I think it really, I think the connection is very much there, in the sense that, with slowing population growth, in order to drive the economy, in order to drive labor force productivity and keep a vibrant and growing economy, innovation, tech enablement, all of these things, critically important to keep the US on a healthy path. Higher interest rates have had some implications also for just like lending and borrowing activity in the US. We've seen tighter credit standards or lending standards filter through. We've also seen less demand for credit in this higher interest rate environment. All those things kind of tell us to expect a little bit of moderation or slowing of growth across the US economy. On the right-hand side, we started putting this chart together when in the aftermath of market disruption about 18 months ago, when regional and mid-sized banks were sort of contending with the sharp move higher in interest rates, and so that's really an area of kind of the banking sector where we've really seen loan growth. It was growing at a pretty brisk pace um, before March of 2023. And then since then, it's been slowing pretty dramatically. So again, it just sort of speaks to less lending activity, less borrowing activity, typically means that economic activity looking forward could moderate a little bit. Supply chain disruptions. I talked about, some of the dynamics outside the US and how elevated tensions. I mean, clearly the pandemic caused major disruptions in global supply chains and significant pressures. That's what we're showing a chart about on the left-hand side here. Is a big spike higher in supply chain pressures during the pandemic. A lot of that has normalized, just sort of like processing through the system, kind of getting most things back online. And then I think also just sort of that other chart I had a few pages ago that showed there's a little bit less relative demand for goods and durable goods, which you would typically associate with supply chains and moving goods and parts and components around the world through the supply chains. And then on the right-hand side, I think is a good illustration of kind of some of the rewiring of global supply chains that's taking place. Again, some of this was already kind of happening pre-pandemic, and then the trend is continuing where, especially for the U.S. and our major trading partners, a little bit of nearshoring and friendshoring, those types of trends, are happening in a pretty orderly way. So with that, I am happy to take any questions. There's the Q&A function. I think you can perhaps also raise a hand.
Yeah, so if anyone has it, Ginger, thank you. Wow, that was a lot of insightful commentary. Certainly gave the audience a lot to digest and think about. We do have a couple of questions, and certainly anyone who's on the line, feel free to post in the Q&A, and to the extent we still have time, we will get through them. So one question came in, would love your take on this. How do you expect the long-awaited easing cycle to affect the valuation environment? Will it take time to filter through the ecosystem?
Yeah, so it's a great question. So in addition to impacting certain areas of the economy, I think the lower interest rate environment is good news for valuations, and it'll kind of disproportionately benefit faster growing companies. So I think a lot of in the innovation economy would kind of fit that profile. We're seeing some early evidence of that play out already in public markets, where we've seen small caps outperform large caps over the past, like since July, by about 400 or 500 basis points. So it's starting to play out in some ways in the public markets. And then I think, there's always a lag between public markets and private markets. So it's something that I think could kind of filter through to the private markets through 2025.
Great, love that. And I think we have time for one more question. So Ginger, in an uncertain environment and an election year, what can companies do today to be better prepared?
Yeah, sure. So I've gotten this question a lot lately. The two things I keep going back to are, and this is probably really in any environment, but I think it's particularly important in uncertain environments where there's sort of, the outcomes could be pretty different. It's really important to scenario plan and sort of understand how your business is going to perform in a wide range of outcomes, whether that's different interest rate environments, different commodity price environments, different inflation environments, labor markets tighter, labor markets looser, all of the above, to be able to sort of understand how your business will perform. I think that's very important. And then another thing that is just always good business practice, I think, is to look at some of your external exposures, things you can't control anyway. If you have FX, euro exposure, or a certain commodity price exposure or interest rate exposure, look for ways to mitigate those risks. And some of that, there are many different ways you could go about that, but they're kind of take that off the table, and then you can just focus your energy on the fundamentals of your own business and growing your company.
Great feedback, Ginger. Thank you. And we could probably sit here all day and talk about this, especially while awaiting the important news to come. But I think we're just about out of time today. So Ginger, thank you again so much for joining us. We really appreciate it. And now to close us out, I'd like to quickly turn it over to Victoria Davenport and Laura Raymond for some quick words about JP Morgan's Innovation Economy Banking.
Thank you, Jess, for the introduction. And Ginger, it's always so helpful to hear your insight. Hi, everyone. My name is Victoria Davenport.
And I'm Laura Raymond.
So as Jeff mentioned, we represent JP Morgan's Innovation Economy Banking team. Our group is focused on supporting high-growth, venture-backed, and private equity-sponsored companies from pre-seed to stage IPO, pre-seed stage to IPO and beyond. We serve every vertical, including software, internet, AI, healthcare IT, e-commerce, and more.
We can help identify the complexities of building a business in your sector and provide recommendations for the best firm-wide products and services. We offer solutions across domestic and international treasury, venture debt, financing, liquidity, capital advisory, and more.
We look forward to staying connected. Laura and my contact information will be provided in the follow-up from Withum. Thank you.
Now we would like to turn it over to Benjamin Rodriguez, Senior Manager at Withum, and Anne Louise Brand, Senior Manager at Withum, who will be diving into all things business valuations.
Thank you, ladies, and thank you to everyone who is joining us today. In this session, we are going to be speaking about insights into business valuations, 409As, and critical areas surrounding managing dilution in the tech industry. With that, I'll be turning it over to Ben.
Thanks, everybody. Thanks, Anne Louise. Hi, I'm Ben Rodriguez. I'm a Senior Manager Business Valuation Expert here at Withum. We're just going to touch on some high-level business valuation concepts. Let me get my screen share going here. Okay, so we're going to touch on how valuations are typically performed at a high level, 409As and their implications for private companies, things to consider, financial impacts, penalties, dilution, etc. So let's go to the first slide here. So first and foremost, to give a broad overview of the methods that we typically consider here, there's three generalized methods when there's not a financing round or a funding round at an arm's length transaction in the near past of the private company. There's a market approach, an income approach, and an asset approach. So the first approach of which is probably the most familiar to most people outside of the valuation space, which is the market approach. That is a comparative analysis where we look at either a public company that's seen as similar or comparable to the private company that we're trying to value, or we'll look at recent transactions for companies that were acquired that are similar to the company in question as well. As a result of that, as we look at those other companies, we'll understand a range of multiples that we can then apply to the subject company. So whether that's a EV or enterprise value to revenue multiple or to EBITDA multiple, whatever is relevant to the company, and we'll get into what makes it relevant or not in a second. That's primarily what we do under that approach. It's good because it reflects current market conditions. It can be a very very up-to-date snapshot of the company's value from a market participant perspective, somebody else who may be interested in buying the company or investing in the company. The second approach is the income approach. So the income approach is probably familiar, but not as simplistic as the market approach. This looks at the forecasts of the company, what the future of the company might hold, and those forecasts typically come from members of management. Usually they're provided in like 3 to 5 year increments. So what I mean by that is whatever you need your valuation as of, you forecast 3 years into the future, 4 years or 5 years, and then your valuation team will take it from there. The risk of those cash flows, so typically there's a lot of growth in those forecasts. The risk of those is captured in the discount rate, which is typically a foreign concept, maybe not a foreign concept, a less familiar concept to those outside of the valuation space. These discount rates are intended to meet the projections. So what I mean by that is they reconcile high growth, high risk in forecast comes with a high discount rate, and commensurately with low growth, low risk, steady state, what Ginger was speaking about. If we're at inflationary levels of growth, then you'd have a much lower, softer discount rate to meet that level of risk as well. The third approach is the asset approach. Now, this is, again, these are traditional valuation methods for the tech space in particular. We'll get into that, but not very applicable for tech companies, vast majority of the time. But this takes the value of your assets minus your liabilities to come up with an equity value there. It's a very simple approach, not seen as something that you would rely on in isolation, and it's typically a floor value for a company. Similarly, the replacement cost way of looking at a value of a business, say you're a tech company and you have a primary software that you deploy, and that's where you get all of your revenue from. How much would it cost to replace that software if it was gone tomorrow? So you could look at the engineering hours, the software developers, how much time it would take, opportunity costs that you'd forego by having to rebuild, etc. And that's the concept behind that method. So now that we have a general understanding of the valuation methods, I want to go into tech-specific considerations that's more relevant to tech companies. So for earlier stage tech companies, the revenue growth is more of a priority. And as a result, we typically lean on revenue multiples in valuing a company of that nature. Now, when a tech company passes that stage of development and they're more profitable, more mature, and growth isn't as significant on the top line, EBITDA becomes more of a focus for our multiple selection instead of revenue. And maybe somewhere in between, you consider both of those. Under the income approach, this approach again is usually applicable, but it can become more challenging depending on the stage of the company. So if we're on the earlier stage side of things, forecasts are harder to justify, or in some cases audit or present to the IRS, which is the audience for these valuations. So for the earlier stage companies, it's more difficult to develop this approach. It's still recommended to use this when you can, but it just becomes more challenging. What we do on the valuation side to kind of mitigate the additional forecast risk that we typically see from our clients here is we'll apply stronger discount rates. So it's very common to see a 20+% discount rate to meet the high level of growth, as I mentioned earlier. For the asset approach, again, just to reemphasize, very rarely used, not something that a tech company would typically concern itself with. And then the replacement cost approach we already talked about as well, that it's primarily a last resort. If you have a software as your primary product, maybe you recreate, how much would it cost to recreate that software, and that can give you kind of like a floor value for your business at that time.
Thanks, Ben. And I appreciate the shout out on complexities surrounding auditing valuations and where maybe the easier approach is for our team. So thank you for that. And so what are some common factors that could impact a company's valuation?
Yeah, good question. So the forecast risk, the forecast growth, the expectations of the company, the dynamics of the industry, maybe their geographical concerns. Are you diversified in your product offering, or are you sticking with a single product? Though all those factors can come into that, and that's a good segue into this next slide here. Let me go there. So 3 kind of categories that we would answer that question in, Ann Louise. Market conditions, company performance, and industry trends. So for market conditions, Ginger did a great job of giving me a layup here by describing the market dynamics over the last couple of years leading into this year. So with some of those higher interest rates, et cetera, in 2023, there was a hesitancy to invest in tech companies, especially after 2021, where there was such excitement at that time. It had to fall to some degree. 2023, we saw that. While 2024, we're expecting a rebound as, again, we'll see what happens with the Fed today on those rate cuts. But if it meets or exceeds expectations there, 2024 is expected to be a better year for growth, for opportunities, lower financing costs, et cetera. That can lead to higher growth, spurred investment activity, acquisition activity, et cetera. So that's one example of market condition that affects the valuation of a business, in particular for tech companies here. Company performance. So market conditions are kind of out of the control of the company to a major extent. Company performance is in the company's control. So something that investors are communicating to us as consultants is, for tech companies, there used to be a primary focus on maximizing top line growth. Nowadays, we're seeing a lot more emphasis put on demonstrating a target company, demonstrating a path to profitability, and demonstrating how they're going to get there. That's been kind of a pivot from an investor standpoint. Another few examples of ways that valuations can be positively impacted by company performance. I'm just going to go through these. Meeting or exceeding last year's budget, improving margin, and another big one is diversity of the products that you offer, the demographics that you offer them to, and the geographies that you're operating in. So better diversity, thinking about it from like your stock portfolio, more diversity, lower the risk while maximizing the return where you can. Last point here is on industry trends. So a lot of tech companies that we're working with are considering or have transitioned to software as a service models instead of a single one-time fee for their customers. The pros, there are pros and cons. Some of the pros, just to touch on that, it improves, or has in the past from what we've seen in practice, has improved recurring revenue, which is a good thing for valuation purposes, and it has improved customer retention as well. So if you're getting more revenue and you're keeping customers at a higher clip, valuation is going to improve twofold there. Another industry trend is relating to AI. I'm sure it's the front of everybody's mind the last year or two here. It's created opportunities, especially in the tech space, to advance or improve existing product offerings while also creating potential for brand new products that weren't possible before.
Very nice, thank you. And would you be able to speak a little bit to why compliance with the 409A valuations is so key for companies in the tech space? Yeah,
absolutely. So there's a tendency for earlier stage companies in general, and tech companies fit into this as well. There's a tendency for cash to be necessary or limited, I'll say, in that it needs to be used to maximize the future growth of the company. And when you can't offer a cash bonus because you're looking to maximize firm growth, another reasonable option to keep your employees incentivized and happy and retained is to issue them options. So when options are issued, they come with regulatory framework, whether that's how the IRS cares to see them valued, or the AICPA for private companies, determining a value there and having that ready for your financial reporting when that comes time. So, and again, another good segue into our next slide here on ASC 718 and 409A compliance. So just to familiarize everybody, ASC 718 is the financial reporting requirement relating to stock compensation expense, which is when you issue options, you have to expense them, versus 409A, which is the IRS's requirement for relaying the tax implications of issuing options. Those from a valuation perspective are identical. So we would provide one single valuation that covers your ASC 718 requirement and a 409A requirement as well. So in general, private companies have one of these valuations performed annually, once every 12 months. Again, it doesn't need to be a separate valuation for 718 versus 409A. It's used in tandem. What can change that 12-month rule is if there are material events. For example, here's a list of good examples here that we see most often in practice. Whether you're acquired, you're changing your business model from a single-use software to a software as a service, and you have recurring revenue. If that business model is changing, that could be seen as a positive indication of value for your company. Maybe you want to do the valuation once that's known or planned, or maybe you have a new funding round. You raised a Class C, and it was priced at $5. That's a good time to get additional option holders involved while also performing the valuation at the same date. It's helpful for both the IRS and the auditors as well. And why, again, to go back to the question she was asking, why do this? What's the compliance concern? If you don't comply with these valuation requirements, for whether it's for the accounting side of things or for the IRS, it can either come with financial penalties. Shareholders may sue those option holders, the existing members of management who are getting those options. If they're mispriced options, they may present some legal issues there. You may have to restate your financial statements, which could lead to delays in filing. Maybe have some debt covenants associated with that are triggered, which may increase your cost of capital. And maybe there's some reputational damage, to say the least, that would go along with the rest of those three.
Okay. And so speaking a little bit more on the timing of this, is there anything that we see typical in practice related to the frequency and timing of these types of 409A valuations and the work done surrounding ASC 718?
Yeah, so again, typically it's like once a year on average. If there's a new funding round, we try to peg along that financing date. Something else to consider is, when are you issuing your options? So if the purpose of this is to value the options primarily, that having a date of valuation that's closest to your option issuance date is ideal, both for both parties that would be reviewing. So let's just say your annual 409A is 12/31 every year, and you have the bulk of your options are issued on June 30th. Maybe you pivot that annual valuation to June 30th instead of 12/31. Otherwise, like I was speaking to earlier, if you're being acquired or a change in your business model, those are good examples of when you might need an additional valuation, depending on the materiality or risk of the options to your financial statement. Okay, so now we're going to get into option issuance. Some considerations or things to keep in mind if you choose to issue options to your employees. One, it's a great way to incentivize performance, right? So aligning interests of your management team with those of the companies is always a good thing. Everyone's steering the boat in the right direction, in the same direction. And in lieu of available cash, this is usually seen as the next best option. So if you're a very mature company, maybe you just offer cash bonuses instead. But when you're high growth and you want to use that cash to your advantage and maximize the benefit that you can see from that cash investment, stock options are typically preferred. It doesn't come without a cost though. So when you issue additional options, it leads to what's called dilution, which limits the upside potential of existing shareholders. So maybe you have Class A or Class B or Class C or common unit holders. When you issue these upside units, these options, the upside is then split into more pockets than it was before. Whereas the low or flat exits, if the company stays stagnant or underperforms and exits, those aren't affected via dilution of these options because they would just expire out of the money or worthless, and those option holders would go home with nothing. So dilution is a consideration. However, it is a primary consideration if the company does well. If the company's doing well, usually there's less complaints about losing 1 or 2% of your upside potential, given that everyone's successfully exiting. Flexibility is another consideration. So options aren't one size fit all. They can be issued with different vesting criteria, different strike prices. You could require that somebody work at the firm for 3 years, 4 years, 5 years before they get the entire benefit of those options. They could be issued with performance vesting criteria, which is almost like a secondary. You'd have your strike price typically set based on your common price, and then you might have an additional requirement to say, well, we want the Series A or Class A holders to get a 3x return, so you guys don't get to participate until they get their 3x return. So there's ways you can modify these agreements to make both your existing shareholders happy, while also incentivizing members of management and your team to make sure everybody's moving in the right direction.
Great. And so when a company does go through the process of deciding to issue more options, could you speak a little bit more to the impact on what that looks like for a company's cap table as well as their overall valuation?
Yeah, sure. So one way that I like to look at it is the first thing that we talked about here is how to value the business itself. So determining the size of the equity or the amount of equity. If you think about that as a pie, so determining the size of the pie is the first step in a valuation exercise like this. The next step is determining how much each slice of pie is worth. So if you have Class A, B, C, common shares, and common options, each of those is a slice of the pie. When you issue more options, the size of the pie doesn't change, but the size of each slice does change, and it shrinks. So again, if you have a downside or flat exit, the option holders don't get a slice, and everybody else is unaffected by their issuance. If you have an upside exit, their slice is then present. The other people in the cap structure, in the ownership of the equity of the company, they have to give up a small portion of their interest in order to feed that other person or that other group of options in this case. So hopefully that answered the question. Okay, thank you. Okay, last slide here. So we're going to talk about additional considerations when issuing options. Just to reiterate, ideally they're issued at or near the original ASC 718 or 409A valuation date. So if you're doing 12/31 valuations every year, maybe you issue your options January 1st or somewhere around there to to minimize the difference in potential valuation concerns that your auditors may have or the IRS may have. It's ideal to line those up. So a very common practice would be to perform your valuations at or near when you expect to provide bonuses to your employees, as that's a very common time to issue these options. Again, to reiterate, these are preferred when cash is crucial to meeting some of those high growth expectations. So if there's a better use for the cash, options are your next best incentivization mechanic or technique that you can use for your employees. Along with that, it helps attract top talent, improve employee retention. There's a lot of excitement when people are issued options in a company that's expecting high growth. It can spur innovation, additional, hours put in order to meet those objectives so that they do get the upside potential of the options that they're granted. And then one other thing to just consider, this is not always possible, so keep that in mind, but if you are in a negative performance period, issuing options during that period worsens dilution, just as issuing options during a very high performance period decreases dilution. So again, it's all about upside from when they're issued. So if a company has a down year, let's just say 2023, there was a peak in 21, they dropped in 23. If there are a significant number of options in 23 and the company is expected to rebound in 2024, then those option holders who were granted options in 2023 are then participating in that rebound rather than true growth from 2021. If that makes sense. So, yeah,
helpful.
Go ahead.
So when speaking to external valuation firms, what kind of role do they play in this process for the 498 valuations?
So valuation firms, again, we have these conversations quite a lot with our clients. The point of this exercise is to make your position, your valuation, as defendable as possible, and whether that's with your auditor or with the IRS. Valuation experts, it's something that we do every day, is make sure that these valuations are going to stand up to as much scrutiny as you could provide. So I think there's a lot of ways that we can help, not just by helping with the compliance side of things, but we can also help with consultations on when it makes sense to issue options. If there's some creativity that needs to be involved in what type of options are typically seen here, whether it's including performance vesting criteria, et cetera. Outside of, I guess the point being, outside of actually performing the evaluation, we're consultants first and foremost. So we're here to help in any management conversations or exercises.
All right, thank you for the clarity on that. Let's see if there's any questions from the audience. Ben, would you be able to speak to what strategies companies can use to manage dilution effectively?
Yeah, sure. So I think I'll kind of tie a couple things together here that we've talked about so far. The performance of the company, tying that into issuances. So if the company's doing well, issuing more options, versus if the company's not doing well, maybe you try to avoid option issuances or defer to cash bonuses if the cash is available. The other things you can do are making your options customized and unique to your specific goals that you have in mind. You can set them essentially further out of the money, meaning the company has to grow more before the dilution comes into play. And you could maybe you do a hybrid approach where you say, for key members of management that we think are driving growth, they get the options. For other members of the team who are not as crucial or pivotal in that decision or in that growth, maybe they get the cash bonuses and kind of meet that in the middle.
Awesome, thank you, super helpful. Let me see, there's one other question. Okay. All right, well, thank you so much, Ben. To wrap up the webinar, I'd like to turn it over to Lynn Musansky-Keck, Principal at Withum, and Melissa Roth, Partner and Clean Tech Practice Leader at Withum, who'll be discussing clean energy tax credits and their impact on tech companies. Thank you.
Thank you.
Excellent. Thank you both. As Anne-Louise mentioned, in this session, we'll be discussing the significance of clean energy tax credits and how you can use these tax incentives to benefit your business and contribute to both a cleaner and more sustainable future. Let's kick off with some questions. So Lynn, can you start by telling me a little bit about the Inflation Reduction Act and how it affects the clean energy sector?
I would love to. So for everyone, thank you for joining us today. It is an exciting time in this space. I'm currently at the Metropolitan Club in New York City, where we're going through an energy conference, and we'll be again in New York City next week for the Climate Week. So a lot of fun stuff going on in this area. But what I wanted to express is the significance it's really having with a variety of our industry subsets. So if you can see on the left, this was the original estimate that the federal government said they're going to help spend and incentivize various companies and individuals to engage in clean energy initiatives. And they originally estimated that would be around 271 billion. Because of the significant uptake and investment that's been put through these initiatives, they're now estimating it could be 652 billion over the next 10 years. And some estimates, not coming out of Congress, but coming out of just general public, some are even estimating that we might see up to $1 trillion spent in the next 10 years. So a significant amount of influx, inpouring of people wanting to be involved in becoming, involved in becoming and investing in clean energy or buying clean energy credits. So that's what I wanted to point out between the left and the right. Really be aware that, even if you don't have necessarily the means or the desire for you to actually directly invest in these energy projects, there still is an opposite side to this transaction, which was opened up by the Inflation Reduction Act, that will allow you to essentially buy other people's energy credits, or even become involved in helping that particular potentially customer claim a credit themselves. So we've seen this industry really boom, and we expect it to keep booming. Here on the right, you can see Crux provided us where they are anticipating the market to go over the next 10 years, and it's quite significant. So where we're seeing most of the investment happening right now, obviously, is in the renewable energy and clean electricity investment tax credit. So that orange area. But we're also seeing, a fair amount of movement, positive movement in clean manufacturing, where we're seeing a lot of our clients become involved in clean manufacturing to try to bring essential products back into the U.S. for their supply chain. So it's had a significant impact, in short, that essentially we are pushing more and more income into the market. You're seeing more and more financing in the market, whether it be traditional bonds, green bonds, or just general tax equity structures. And so we are seeing a significant increase and a really change in the entire dynamic of what clean energy is going to look like in the next 10 years.
Right, excellent. So you mentioned it briefly that, people can get involved if they're not creating the clean energy projects or working on those investments. Can you kind of delve a little deeper into how they can get involved?
Sure. So I think if we go to the next slide, I give a great example, but we have a variety of clients who might be sitting there and saying, well, I'm not going to produce clean energy supplies, and I'm not going to potentially put into play solar power. But essentially, I still want to be involved, right? I still want to contribute to this initiative. And so what C corporations are probably the easiest example of what they're able to do is they're able to buy clean energy credits that were made by someone else to offset their own tax liability. And we're seeing a lot of movement in this area. It did take a while for this to be comprehended and ensured that it is indeed actually part of the Internal Revenue Code, that the government is asking you to be involved this way. But for example, we had a large C corporation who had a $20 million tax liability, and they were essentially able to go out and purchase a credit that was generated by another entity for $18.6 million. And what that benefit is you're essentially going to be able to say to the federal government, oh, by the way, I'm going to put a $20 million tax return or $20 million tax credit against my liability. But I really only had cash go out the door of 18.6. So when you look at, different parts of accounting due diligence with this and potentially legal involvement in the sales purchase agreement, you're seeing significant savings still of about 1.2 million. And so what we do and we help our clients do is to measure, get to understand their risk tolerance. And I will say by far, our most conservative credit that we are buying is the 45X for the reasons you see on the slide, right? We don't have additional loopholes to cross like we do, for example, in the 48 energy credit. So for example, no prevailing wage and apprenticeship requirement, no domestic content, no location, no recapture. All we're really looking for us to do is to say they made an eligible component, which is part of the energy group supply chain, and they sold it to a third party. So that's a really low risk credit. Hence the reason, they're trading at 93 or 94 cents in the dollar. Energy credits, on the other hand, can have those requirements. So now you're taking more risk on. Did they meet domestic content? Do I feel comfortable they met it? Did they meet prevailing wage and apprenticeship requirements? But we are seeing this ability to buy and sell credits being very advantageous for our client base, and we only anticipate it to increase going forward.
All right, excellent. Now that we understand a little bit more participation on kind of both sides there, I want to take a quick step back and can we talk a little bit about the goals of this act? And at this point, do we think it's working?
That's a great question. So as we go to the next slide, you'll notice that the goal, if anybody remembers the Paris Agreement that we were in previously from an environmental standpoint, and then we backed out of it and we came back into it. The goal was to reduce emissions by 50% by the 2030 taxable year or the 2030 year. And so what's nice to see on the left side of this chart is, scientific assessment that essentially we're going to see a more significant decrease in our emissions with the IRA than not. So while it's not anticipated we'll meet what was required within the Paris Agreement, we will be closer to it because of this initiation. And I would point out that this is not something new per se. A lot of people are involved in energy initiatives, clean energy initiatives in the past. It's just the significant changes made within the clean energy initiative space that is making this that much more attractive. Essentially what the government said is we need to have a significant decrease in our emissions. How can we do that? Well, we can't just do it as a federal government issuing grants or tax credits, but we really need it to be a US-wide effort. So as part of this, they not only allowed middle market companies to really get involved in buying credits like we just talked about, but they also allowed not-for-profit entities. So we're working with Indian tribes, we're working with hospitals, we're working with colleges and universities, who now never before have they been able to get any type of incentive for investing in clean energy. And now they're being able to essentially do a direct pay election. So that's kind of the reasoning behind it. That's their goal. There hasn't been any reporting out yet as to how much our emissions are dropping. It's still early. As a reminder, this just went in 2 years ago, but it is kind of the focus of the main driver being to reduce emissions. But on the opposite side, it was smartly written, right? It was done really well. And the fact that they said, not only do we want to reduce emissions, but we want all Americans to benefit from this. So they really are focused on there being not a division between high wealth and low wealth areas and who gets access to clean energy. And you'll see that through a variety of different places that say, you'll get an additional amount if you're in low income communities. You'll get an additional amount if you're in certain energy communities, if it previously was related to coal, right? That no longer is driving the economy there. So they focused on that. And they also mandate to get a higher credit for larger projects that you need to meet prevailing wage and apprenticeship requirements. And essentially that puts kind of everybody on a union wage. So strengthening our labor contracts. And then as we already mentioned, a really huge impact in opening that ability for our not-for-profits and governmental agencies to get involved. So the one thing I do like to point out in this space, especially for startups, is we see significant movement, obviously from a variety of perspectives, but this particular fact really was shocking to me for manufacturing for clean energy. So we're seeing that is by far seeing the fastest growth. Previously, prior to the Inflation Reduction Act, they invested about 22 billion in clean energy, and now it's totaling 90 billion. So previously, for $1, for every $10 they spent, $1 was in clean energy. Now for every $4 they spend, $1 in clean energy. So significant game changer that the Inflation Reduction Act has put into place.
Okay, so I think what I kind of heard is that don't just assume that you can't qualify under one of these different waves or one of these different approaches, because there's a lot of openings and opportunities for people to get involved more than you would normally think. Is that accurate?
Absolutely. So from colleges and universities getting involved to corporations buying other energy efficient credits that were generated by other companies, there's a variety of different ways that you can get involved in this practice.
Okay. And I guess in this, economic environment with the elections right around the corner, there's a lot of unknowns. And do we know if this is going to continue to be supported as we go through the election process?
So that's a great question. So it's a hot topic, even at this conference that I'm attending right now. The one thing I would like to point out is if there is a change, right, that we have a Republican president instead of a Democratic president, there's fear that the IRA could be wiped away. And I would say that's not going to happen. And I'll explain why in a second. But essentially, I think if we get a change in presidential leadership, we could potentially see some things be tweaked. Those things could include, we've seen a lot of complaining about EV vehicles. So Republican parties have been wanting to change and have even proposed some bills in the House about how that would look. And we have Republicans in general have not supported hydrogen clean energy. So I could see things move in that area. But even though the Inflation Reduction Act is primarily touted as a Democratic bill and a win for the Democrats, it's important to realize that it's benefiting mostly red states. So on the left-hand side, this graphic is just great to show you or ease your concern about major political change. Will it wipe away all this investment in clean energy and movement? I would say strongly no. I don't think the Inflation Reduction Act will go away. Again, there could be tweaks, but it's not going away. And the reason I feel comfortable saying that is on the left-hand side of the screen, you'll see investments, right? Light green to a very dark green. And so a significant amount of money, which we know is going into the economy surrounding this. And then when you compare, those dark green areas, they're actually in red districts, Republican districts, right? And so even though the bill was Democratic, we're actually seeing the majority of people reaping the benefit for the bill is in Republican states. So that's an interesting fact I like to share to people to give them an ease of what could come in November.
So I guess if we're thinking that it's most likely this is going to stay, however, with some tweaks, is there anything that people should be considering, whether they've already applied or whether they're thinking about applying, anything they should be preparing for now in case there are changes?
Yeah, so I would say there's two significant changes that are going on. One has to do with obviously the November elections, which we don't have much control over, but another is really a significant change in the investment tax credit. So I think if you go ahead 2 slides, maybe this would be a great segue to essentially highlight that many people are currently using what we call Section 48. So that's including biogas facilities, waste management facilities, solar power, battery storage, really a long list of items that have been allowed to, if you place it into service, take a significant credit. And that credit, just as a touch point for everyone on the call, can be as low as 6% or could even be as high as 60%, depending on how many hoops you jump through. But as of 12/31/2024, that 48 credit goes away unless you're safe harbored, which if you're interested in knowing what that means, come talk to me. But on the right-hand side, we're going to tech neutral and only tech neutral activities for electricity. And so one of the things that I think is fascinating that a lot of people might not have put 2 and 2 together yet is our electricity costs or electricity demand in the US is going to skyrocket. And in the next, I think the 3 to 5 years. And the main reason we're seeing that skyrocket is because of artificial intelligence. And so we're going to have much more need for electricity than we ever have had before. And the growth of the need is going to be much higher than we've ever seen before. So 48 has been a beautiful thing for the last 2 years, but 48E goes into effect and says, okay, if you have these other things like battery storage technology or a biogas facility that creates renewable gas, you're no longer in a Section 48 credit. And so this could be quite daunting for people. And so this, on top of the November elections, is what we're trying to communicate to a variety of our clients to make sure that we have them prepared that if they need to be under the legacy Section 48 credit, they indeed are. And then if you aren't aware, I would say there's generally 2 ways you can get a credit for these energy projects. The first way happens to be structured around an investment tax credit, which is a one and done, right? In the year it's placed into service, you claim the credit. Alternatively, you could go after a production tax credit. The production tax credits generally last over 10 years. And that also is switching to a tech neutral coming into the 2025 year. So I would say for anybody wanting or thinking about investing in this area, this item that we're currently reflecting would caution me more or make me want to prepare more than potentially any changes that may happen after the November elections.
Got it. Perfect. And I guess we threw out a lot of numbers there. You just kind of described 2 of them, but if we can go through maybe all the options we have for credits, is there any, cross-pollination where we can take multiple credits at once? Talk a little bit about that.
Yeah. So again, this is what we're seeing dominating in our market at Withum right now. So we have clients in the investment tax credit, from combined heat and power systems to biogas facilities, the gamut. And so that's, as we just discussed, going to kind of go away for some of our clients if they don't start construction in the current year. 45X, advanced manufacturing production credits. That's, again, those credits that we're trying to bring the supply chain back into the US for solar panels, back into the US for battery cells, critical minerals. That also is a significant credit that many of our manufacturing clients are getting involved in. Carbon sequestration credit is a great credit as well. And then commercial vehicle credit. So this is much easier to get into than your personal one, right? I don't have to have a critical battery component being met. It doesn't have to be manufactured in the United States. These are commercial vehicles, right, that you'd be using in your trade or business. So an electric vehicle used in your trade or business. You might see Disney, for example, or you might see Universal trying to become more involved in this space so that they can pronounce how good they are for the environment and how they're working towards the clean energy initiatives. One of the items that I would point out is many people who are taking the 48 credit with waste management or biogas property could also take the 45Q carbon sequestration credit. They're essentially double dipping. They're allowing both. And as we transform to 48E, the ability to take both those credits distinctly and separately is going to be limited. So a lot of interesting items going on in this space with a lot of startups. We have, especially under 45X, we have a lot of battery cell startups and solar startups. Some of them straight from scratch. Some of them seeing a lot of investment coming in from Europe and Asia.
Excellent. And I know this isn't a webinar on ESG, that's a little further out, but my understanding is that you could take some credit for the fact that you've done these and that you can apply for these under ESG reporting as well. Is that accurate?
Yes. So that's why we are actually seeing a lot of inbound movement, because they're coming, for example, Europe has ESG reporting. And so they're coming into the US and now they're reporting, for ESG purposes, while also getting some type of government incentive, right? So they're not in charge of absorbing the entire cost. The other thing I would say is the selling of RECs, which is kind of part of the ESG discussion, right? People might say, well, I need to report out for ESG purposes, and I have to buy RECs to prove that I'm, meeting my ESG goals. And so that's another kind of ESG concept that can be layered on top of the tax credit incentives. So what we actually have found is we have some clients who say, oh, I'm selling these RECs, these are great. And then we say, well, do you have a tax credit you should be taking? And they forget that side. Or we have people saying, oh, well, we have this amazing tax credit. And we're like, well, have you considered the RECs? And I'll just say a little bit, Europe obviously has the ESG reporting, but we are seeing more and more companies in the US pick it up. And there's two reasons for that. So obviously, large multinational companies are reporting out something on ESG. They tend to be. But what we're also finding is that suppliers who want to supply to Walmart, who want to supply to different large multinationals who have ESG reporting, are being asked to report themselves, right? So a startup who is going to now be selling into those stores, they're going to have you fill out an ESG report on how you're manufacturing and dispersing your property. And so that we've seen an uptick in that having to be completed and assisted with our clients as well.
Excellent, very helpful. Just checking to see if we have any questions. So I guess one question is, what areas of the credit process do we find that, people are often missing as they go through the application?
Yeah, so it's a reoccurring theme that we're hearing here and elsewhere, is that many people are trying to get the higher credit, right? I want to jump from 6 to 30%, so 5 times higher credit. And to do that, they often need to meet the prevailing wage and apprenticeship requirements. Remember that linkage to saying, yes, everyone is benefiting from this clean energy initiative by the government, and you're paying people the prevailing wage or the wage determined by the Department of Labor. Last year, you didn't see a lot of that going on because people started their projects prior to when the regulations were issued for the prevailing wage and apprenticeship requirement. This year, you're seeing it more and more. And unfortunately, we have some clients come to us and say, put this credit on my tax return. And we'll say, okay, like, where's the prevailing wage and apprenticeship items so that we can review? And contractors and subcontractors are just representing it in a contract, right? They're saying they meet it in the contract. But when you talk to your tax professionals and you talk to your business advisors, it's very clear based on the IRS regulations that it needs to be more than represented. If you're essentially taking the credit, you need to be able to show the number of workers that worked on your engagement. You need to show, were they classified as an electrician? Were they classified as a general laborer? And you need to show apprenticeship requirements if applicable. So overall, I would just point out that, it's not mind-boggling. This has been done in the past for government grants and various labor unions, but it is something new to the for-profit world. And so I would just remind everyone that, to get your advisors brought in sooner rather than later at the beginning, right? So we can cross-check those contracts, and not only do they have to meet it, but they have to provide us the proper documentation so we can audit it. And so that's a common one that we see again and again as we continue to push down and we're away from anything being grandfathered, that it is indeed causing some problems for our clients.
Okay, excellent. Thank you so much, Lynn. I think that kind of wrapped up our questions. So really appreciate everyone helping us out today and presenting today. Thank you all for attending. The video recording is going to be distributed to all of the attendees. And if you have any questions regarding either the panel or any other matter, please feel free to reach out to us. Thank you again, everyone. Have a great day.
Bye-bye.